Good morning to both of you, gentlemen. Jack, how big of a risk factor is the coronavirus for this market?
You know, it's still hard to tell, Sarah. Spreading faster than SARS. SARS took 1% out of China growth for one quarter. You know, I think it's still too early to tell to draw lines between the virus and the impact on the global economy. But clearly, investors were banking on this global recovery. We sort of suffered a 1-2 punch of increasingly worse news from the virus and, of course, disappointing Q4 results in the U.S.
Kirk, how would you advise clients and investors what to do? Would you buy, take the opportunity on some of these virus dips and the scares, or is it just too uncertain?
Well, I think you want to trade through this. I think you want to own the stocks that you want to own at the end of the year. I actually have the view that it's very similar to 2003. And I think what will happen is you're going to have the volatility short term, but there's some great buying opportunities. And, you know, what's very interesting to me, I think, ironically, this actually may benefit the U.S. markets in terms of agricultural exports. And, you know, once the dollar comes off its high and starts to weaken, it could be good.
Hey, Jack, we're going to enter a bit of a political silly season here pretty soon with the caucuses on Monday. Is the thinking right now that a Sanders victory is market negative because of his left policies, or market positive because there's a belief out there that he would easily lose to Trump?
Yeah, I mean, I think so far investors are not taking a prospect of a Sanders nomination too seriously. I think that, you know, the Democrats probably recognize that promoting a candidate that's too far to the left will undoubtedly result in, you know, election failure to start. So I think that where the investors will start to take notice is if you see, you know, growing likelihood of, say, a Biden or a Bloomberg that could potentially challenge President Trump.
Kirk, we just did a little piece on utilities, trading at record highs, best performing group of stocks so far this year. Is that where you want to continue to be despite more expensive valuations in this kind of market?
Well, that illustrates to me the flight to safe haven. That's a very similar trade to buying treasuries. And I think the thing you got to worry about is duration. So interest rates have come down on the 10-year treasury from 1.9 to a little below 1.6, which is a pretty big move. And obviously, REITs and utilities and those kind of things are going to do pretty well in that environment.
What is the driver right now, Jack? Is it earnings? Is it the Fed kind of doing no harm yesterday and keeping the balance sheet growing? The coronavirus?
Yeah,
I mean, what's the catalyst?
In my view, I mean, if you're looking at 2020 in its entirety, it's got to be absolutely earnings. The fact is that 90% of the return that we enjoyed last year was a result of valuation expansion. We can't account on PE expansion this year unless we see an appreciable drop in yields, which doesn't likely can be in the cards, where we could have, you know, earnings positive and yields dropping. So that means that the price appreciation in the market has to likely at best match earnings growth. Right now, expected to be about 9% year over year through 2020. Maybe add, you know, 2% for dividend yield. Best case, 11% to the upside. Of course, if now investors decide collectively scratch their head and look at valuation, or if yields somehow rise for some reason, we could see potentially 15% downside. You know, what that suggests to me is, you know, continue to hold your positions, continue to monitor earnings, and it's all about fundamentals this year, in my view.
Well, some argue, Kirk, that it remains about the debate whether or not the Fed is engaged in QE or not. We tried to get, or Leisman tried to get Powell yesterday to talk about whether or not a reduction in repo operations in Q2 could amount to a taper tantrum. He wouldn't really go there. But why would you want to be long through April if, in fact, the Fed was going to take that liquidity out?
I think that the Fed has made it clear that they are going to continue to support the market. And to your earlier guest comments, it's all about earnings. I mean, the S&P was up 25% in the last 3 years, and earnings are up 25%. So all things being equal, if earnings are up 9 to 10% at the end of the year, the S&P is going to be up 9 to 10%. So, but the Fed is, whatever their short-term comments are, they've continued to indicate they're going to be accommodative.
It's not necessarily been the case, though, Kirk. I mean, stocks have outrun earnings and vice versa for the last few years because it's all been about the Fed.
Yes, but there's a lot of liquidity in the system. Anytime the money supply is growing faster than the GDP.
Wait, but we just said it was all about earnings.
Well, it is, but also the money supply. And my earlier comment that the Fed has been accommodative and put more money in the system is contributing to share buybacks and dividends, and which helps earnings.